Hey guys, Joel Franklin, market analyst for YouTrading, and in today's video we're going to be taking a quick look at markets, some of the key themes that are going to be in play this week, and we're going to be taking a look at the economic calendar as well to go through some of the sort of key event risks that you should be keeping an eye out for this week. But let's just start by giving you a bit of a market update, basically, because for me this is pretty much the most important thing to talk about right now, this second, and it looks to me as though we're seeing a bit of a shift in some of the momentum in a lot of these important markets, okay? In a positive direction, in a risk positive direction anyway, not positive if you're a safe haven asset that could suffer from this. But anyway, looking at this chart here, this is the S&P 500, or it's actually a CFD of the S&P 500 that follows the futures. But it pretty much shows that we might be seeing a breakout here, or in the early stages of a breakout here, of a long-term downtrend that, to be honest, I thought we were going to stay in for a little bit longer. But you got to trade what you see, guys. And look, this downtrend that's been in place since March looks like we've pushed above it, okay? Now, we haven't broken above these recent highs, and there's the 50-day moving average there. That's that sort of orangey red line. So if we are really going to have a bullish move, like a proper bullish move, we're going to need to get above these levels as well. And then you would really know that the near-term momentum has taken a turn for the better. But that's what I'm watching out for at the moment. So why have we rallied? Just quickly to explain. Data last Friday, the retail sales data, US retail sales data was stronger than expected, which has eased recession fears. The Michigan consumer sentiment data, typically not as important or as widely followed, but that seems to also be helping risk appetite as well, because first of all, the headline numbers showed that, okay, consumer sentiment is still very, very bad in the US, but they weren't as bad as feared. Again, easing recession fears. But the other factor, which people have been watching closely recently, is that the University of Michigan puts out each month consumer inflation expectations, okay? And the Fed and other central banks, for them, monitoring consumer inflation expectations is very, very important, okay? Because what's one of the Fed's key things that it needs to do, if it is to keep inflation at 2% in the long run, is to manage inflation expectations, okay, because they're a self-fulfilling prophecy. Obviously, you've got market-based measures of inflation expectations, but that's very much what investors expect, okay? You also need to manage consumer inflation expectations. But anyway, the consumer inflation expectation numbers last Friday, they fell back towards the Fed's 2% inflation goal. They're still quite substantially above it, but they did move in the right direction, which has eased fears about a 100 basis point rate hike from the Fed later this month. I mean, you've also had Fed members saying that they prefer a 75 basis point rate hike to a 100 basis point rate hike, because remember last Wednesday we had the upside inflation surprise, headline CPI hitting 9.1%, and that spurred some people to say, oh, maybe the Fed's going to do a 100 basis point rate hike. Well, no. Fed members have told us they're going to do a 75 basis point rate hike, and as I've just been explaining, the latest data suggests that 75 basis point rate hike is also appropriate, okay? So aggressive Fed rate hikes, they helped with this latest move, okay? And yeah, there's some narratives certainly that could gain traction in the next couple of days or weeks that could help sentiment. So we've got earnings, okay? We've already had some big bank earnings. We've got some more big bank earnings this week. So far, the earnings season has been better than expected, from what I was reading on Reuters earlier anyway. So if earnings are positive, that could help. If we start, if this inflation having peaked narrative starts gaining some traction, that could help as well, okay? So if we do break above all these levels in the S&P 500, you know, it looks like we're going to go above 4,000 pretty quickly, the 4,000 levels there, and then you'd want to be targeting these highs from early June / the end of May. And yeah, that's the S&P 500, but how is this affecting other asset classes? Well, let's take a quick look at currencies now as well. The safe haven dollar pulling back a little bit, as you would expect, okay? You got this area of key support though, which I most certainly will be keeping an eye on. And depending on how I view things, if we get back here, this might be an area that you might want to add to longs, because, okay, maybe risk appetite does take a substantial turn for the better and stocks rally to that bit that I just said, which could pressure the dollar down to here. But when it comes down to it, the Fed still going to tighten aggressively, and the US economy still seems to be in a stronger position compared to many of its rivals, and the Fed is going to be much more hawkish. So it's still the potential for this to happen, okay? It's when we really start talking about a more dovish Fed, that's when we can start seeing US bond yields falling and the dollar really, really pulling back. But as long as we're still talking about a hawkish Fed, it's difficult to imagine such a move. Speaking of central banks, we've got the ECB this week, which means a lot of euro dollar, or a lot of people are going to be looking at euro dollar, which just fell below parity last week. Had a bit of a rebound in the last couple of days because of obviously the dollar pulling back a little bit. Similar with the Dixie, but the inverse. I'm looking at this sort of 103.50 area. Could be a nice place to sell. But yeah, anyway, we've got the ECB this week. They're probably going to hike 25 basis points. Really, they should go bigger, but they're basically wussing around, and they really want to stick to their forward guidance. They're also going to unveil an fragmentation tool, which is sort of designed to make sure that Italian and Greek and Spanish and Portuguese and highly indebted Eurozone nation bond yields don't completely blow out versus, you know, German bond yields or Dutch bond yields. So a couple of things to be monitoring. And obviously we've got this ongoing saga where is Russia going to stop gas flows? Okay, so we're going to know on Thursday. That's when the planned maintenance period for the Nord Stream 1 pipeline is up. Yeah, we'll know on Thursday whether Russia's sending gas, basically. And if Russia isn't sending gas, well, you got to think that's a downside risk to the euro, right? Because that pretty much guarantees a recession, guarantees a further surge in Eurozone gas prices. Yeah, so that is one of the things I'd be looking out for. What else? Let's look at oil, because contrary to what stocks are doing, oil very much still in a downtrend. And oil seems to be being driven at the moment by demand expectations. And it's not like stocks where, with stocks, you can be in a recession or be in an environment of a weakening economy, but stocks can still move higher if that means central bank stimulus or government stimulus of some sort, which can boost stock valuations in another way. Well, the thing is, recessions are pretty much always just bad for stocks, basically. Bad for oil. It's not what I meant to say, not stocks. And it's more difficult for a dovish central bank to help out oil. So this trend line could well continue, although obviously if we do see stocks surging, there is always a possibility that we could break above this downtrend as well, because the supply side fundamentals are still not good for oil. Okay, so I'd be very, very surprised if, you know, we saw this trend line continue, you know, all the way down to like 60 or something like that, $60 a barrel. But also bear in mind we're at this 200-day moving average, which is quite a key area of support, and that coincides with these March, early April lows. Okay, so there is quite a strong support there. So just going to have to see what happens with oil. Let's look at the calendar then, go through the rest of the events. Okay, what do we got? Yes, UK CPI expected to, get closer to 10%. It's going to keep putting pressure on the Bank of England. Whether that can deliver a lasting boost to sterling remains to be seen. But actually, I just wanted to show you this quickly as well. Bit of a short-term shift in sterling's momentum. We were in this downtrend. We've just broken above it. Looks like we could test this 21-day moving average here, just near 121. Even potentially move back towards these recent highs here. 120, 122.50, 123, that kind of area is on the cards, potentially. And hot inflation could help that. Canadian inflation too, so something for the loony traders to keep an eye on. Bank of Japan doing their monetary policy decision on Thursday night. Going to be dovish still, so that could potentially pressure the yen, as has happened so many times in the last couple of months. Obviously ECB, we already spoke about that. Bit of US data, Philly Fed manufacturing, unemployment claims. Oh, this is interesting, yeah. Flash PMIs out of the Eurozone and the UK and the US on Friday. So that's an update. How's the economy doing in July? Obviously, recession talk is a big theme at the moment. So that's one to watch. And then you got Canadian retail sales data as well, against the backdrop of a very, very hawkish Bank of Canada, which just raised interest rates by 100 basis points last week. But anyway, guys, that's the week ahead. Hope you enjoyed the video, and I'll see you all in the next one.